Picture this. It's 1996, and the world's financial markets are ablaze with excitement. Technology stocks are soaring. Day traders are making fortunes overnight. The internet is transforming everything. And sitting in Omaha, Nebraska, a 66-year-old man writes something in his annual letter to shareholders that would make most investors do a double take. Lethargy, bordering on sloth, he writes, remains the cornerstone of our investment style. His name is Warren Buffett. His net worth at that moment stands at $16 billion. Today, nearly 3 decades later, that figure exceeds $160 billion. The lethargic sloth-like investor became one of the wealthiest humans on earth not by chasing the latest trends, not by making bold daily trades, not by timing the market with precision. He did it by being boring. Deliberately, systematically, almost aggressively boring. This is the Warren Buffett paradox. In a world that glorifies action, he chose inactivity. In markets that reward speed, he practiced patience. In an industry obsessed with the next big thing, he invested in companies that sold sugar water, insurance policies, and paint, and it worked. Not just worked, but worked so spectacularly that it defied every assumption about how wealth is built in modern markets. The numbers tell a story that seems almost impossible to believe. From 1965, when Buffett took control of Berkshire Hathaway, a failing textile company, through the end of 2024, the company's shares skyrocketed 5,502,284%. Not a misprint. Over 5.5 million%. During that same period, the S&P 500, with dividends included, returned 39,054%. Impressive, certainly. But Berkshire's compound annual gain over those 6 decades tallied 19.9%, compared to the S&P's 10.4%. Nearly double the market's return, sustained over 60 years. But here's what makes this truly remarkable. Buffett achieved these returns not through complexity, but through simplicity. Not through constant activity, but through deliberate stillness. While hedge funds employed armies of analysts and deployed sophisticated algorithms while day traders stared at screens watching minute-by-minute price movements, Buffett was reading financial statements in his office in Omaha, occasionally buying a company, and then in his own words holding it forever. Our favorite holding period, he told his shareholders in 1988, is forever. Not a year. Not 5 years, forever. This wasn't hyperbole. Berkshire first invested in American Express in 1991 and has held those shares for more than 3 decades. The company took its first stake in Geico back in 1976, nearly 50 years ago. These aren't trading positions. They're permanent ownership stakes in businesses Buffett believes will continue creating value long after he's gone. The paradox deepens when you consider what Buffett actually invests in. These aren't exciting companies. There are no artificial intelligence startups, no blockchain ventures, no revolutionary biotechnology firms. Instead, we find Coca-Cola, a company that sells carbonated sugar water; American Express, which processes credit card payments; Geico, an auto insurance provider; furniture stores; paint manufacturers; railroad companies; brick makers. One of Buffett's most instructive investments came in 2000, right at the peak of the dot-com bubble. While investors poured billions into internet companies with no revenue, Buffett purchased 8 companies for $8 billion. Their industries? Brick, carpet, insulation, and paint. The very materials needed to build houses. Products so mundane, so everyday, that they barely registered in the financial press. Yet within a decade, as the housing boom of the early 2000s unfolded, these boring businesses generated enormous returns while most of the glamorous tech companies of that era collapsed into bankruptcy. This is the method that seems to defy logic. In an age of instant gratification, Buffett preaches patience. In markets driven by fear and greed, he advocates calm rationality. In an industry that rewards activity, he champions inactivity. And yet, his approach has consistently outperformed nearly every active trader, every sophisticated algorithm, every hotshot portfolio manager chasing the next big winner. The question isn't whether Buffett's boring method works. 6 decades of returns have answered that conclusively. The question is why it works. Why does doing less generate more? Why does patience outperform speed? Why do boring companies beat exciting ones? The answers lie not in complex financial theories or advanced mathematics, but in understanding a few fundamental principles about markets, human psychology, and the nature of compounding wealth over time. This is the story of how Warren Buffett built an empire through boredom. How he killed market volatility not by fighting it, but by ignoring it. How he turned the conventional wisdom of Wall Street completely upside down and proved that in investing, as in few other pursuits, the tortoise doesn't just beat the hare. The tortoise dominates so thoroughly that the race isn't even close. The foundation: why boring beats exciting. To understand Buffett's boring method, we must first understand where it came from. The philosophy didn't emerge from nowhere. It has roots tracing back to a basement classroom at Columbia Business School in the late 1940s, where a brilliant investor named Benjamin Graham was teaching a revolutionary approach to stocks. Graham had lived through the 1929 crash and the Great Depression that followed. He watched fortunes vanish overnight as speculators who had bet on ever-rising prices were wiped out. From those ashes, Graham developed a philosophy he called value investing. The core idea was elegantly simple. A stock represents partial ownership in a real business. That business has intrinsic value based on its assets, earnings, and future cash flows. If you can buy that stock for less than its intrinsic value, you've created what Graham called a margin of safety. Imagine you determine a company is truly worth $100 per share based on rigorous analysis of its financials. But the market, driven by pessimism or simply ignoring the company, is selling shares for $60. That $40 gap is your margin of safety. Even if your analysis is somewhat off, even if the company doesn't perform quite as well as expected, you still have room for error. You've bought something worth more than you paid for it. Buffett, studying under Graham in 1951, absorbed these principles completely. But over time, he refined them. Graham had focused on finding cheap stocks, companies trading below even their liquidation value. Buffett, influenced by his business partner Charlie Munger, evolved the strategy. Instead of merely seeking cheap companies, he began looking for wonderful companies at fair prices. Companies with durable competitive advantages. Companies that could compound value over decades. This is where the concept of the economic moat enters the picture. Buffett borrowed the term from medieval warfare. Just as a moat protects a castle from invaders, an economic moat protects a company from competitors. It's a sustainable competitive advantage so strong that rivals cannot easily replicate it. These moats come in various forms. Sometimes they're built from brand power so strong that customers willingly pay premium prices. Think Coca-Cola, where the brand itself creates value beyond the actual beverage. Sometimes they come from cost advantages, like Walmart's ability to offer lower prices than smaller competitors because of its massive scale. Sometimes they emerge from network effects, where each additional user makes the product more valuable to all users. The beauty of an economic moat is that it compounds over time. A strong brand becomes stronger as it accumulates decades of consumer trust. Cost advantages widen as scale increases. Network effects accelerate as adoption grows. And for an investor with patience, these moats translate into steady, reliable returns that accumulate year after year after year. But moats alone don't explain Buffett's success. Plenty of companies have competitive advantages. What sets Buffett apart is his unwavering commitment to long-term thinking and his deep understanding of compound interest. He calls it the eighth wonder of the world, and for good reason. Compound interest is what happens when your returns generate their own returns, which then generate even more returns, creating an exponential growth curve over time. Here's a stark illustration. If you invested $10,000 at a 10% annual return and simply let it compound without adding another dollar, in 25 years you would have over $108,000, not from additional contributions, not from brilliant trading, just from patient compound growth. But here's the critical part. Most of that growth happens in the later years. After 10 years, your $10,000 grows to about $26,000. Solid, but not life-changing. After 20 years, it reaches $67,000. Getting interesting. But in those final 5 years from year 20 to year 25, your investment nearly doubles again, jumping from $67,000 to $108,000. This is why Buffett's favorite holding period is forever. The longer you hold a quality business, the more time compound interest has to work its magic. Every year of patience adds exponentially more value than the previous year. But accessing this power requires something most investors struggle to maintain: the ability to do nothing while your investments grow. This brings us to perhaps the most counterintuitive element of Buffett's philosophy. In investing, activity is the enemy of returns. Every trade incurs costs. Brokerage fees, bid-ask spreads, and most significantly, taxes. In the United States, if you sell a stock less than a year after buying it, your gains are taxed as ordinary income, potentially at rates up to 37% for high earners. Hold for more than a year, and those gains become long-term capital gains, taxed at just 20%. Hold for 5 years, 10 years, or as Buffett prefers, forever, and you defer those taxes indefinitely, allowing your full return to continue compounding. But beyond the financial costs, activity carries psychological costs. Every time you sell a winning stock, you must decide where to redeploy that capital. You must find another opportunity as good as the one you just sold. You must time your exit and entry correctly. You introduce dozens of new decision points, each carrying the risk of error. Buffett removes all those decisions with a simple rule. If the business remains strong, the management remains competent, and the competitive moat remains intact, hold the stock. Don't sell. Don't trade. Just hold. This is what he means by lethargy bordering on sloth. It's not laziness. It's disciplined inactivity. It's the wisdom to recognize that once you've found a wonderful business at a fair price, the smartest thing you can do is nothing at all. Let the business compound. Let time do the work. Let boring generate wealth. The power of this approach becomes clear when you examine the alternative. Studies have shown that the average mutual fund investor, constantly moving money between funds chasing recent performance, earns returns significantly below what they would have earned by simply buying and holding. Research from the St. Louis Federal Reserve found that between 2000 and 2012, this return-chasing behavior resulted in annual returns that were 36% lower than buy-and-hold strategies. The more investors traded, the worse they performed. Professional fund managers fare no better. Despite armies of analysts, sophisticated research, and full-time dedication to markets, the vast majority of actively managed funds underperform simple index funds over long periods. Why? Because they're active, they trade constantly, they incur costs, they make mistakes. They let emotions drive decisions. Buffett, through his boring method, sidesteps all of this. But Buffett's philosophy isn't just about avoiding mistakes. It's about actively exploiting the mistakes of others. This is where his famous maxim comes into play. Be fearful when others are greedy, and greedy when others are fearful. Markets are emotional. They swing between euphoria and panic, often moving far beyond what rational analysis would justify. These swings create opportunities for patient, disciplined investors. When markets soar and everyone feels invincible, that's when Buffett becomes cautious. Valuations are stretched. Prices reflect excessive optimism. The margin of safety has disappeared. Better to sit on cash and wait. But when markets crash and fear grips even experienced investors, that's when Buffett gets greedy. Solid businesses with strong moats suddenly trade at deep discounts. The margin of safety is wide. These are the moments when fortunes are built. During the 2008 financial crisis, while panicked investors sold everything, Buffett was buying. He invested $5 billion in Goldman Sachs and billions more in other companies he believed were fundamentally sound but temporarily out of favor. These investments, made when fear dominated markets, generated enormous returns as the economy recovered. This wasn't luck. It was the boring method in action. Find quality businesses. Wait for the right price. Buy. Hold. Let time and compound interest do their work. The mathematical reality of long-term investing supports this approach completely. Over short periods, days or weeks or even months, stock prices are essentially random walks, driven more by sentiment and noise than fundamental value. But over years and decades, prices converge toward intrinsic value. Good businesses create value through earnings and growth. That value eventually reflects in stock prices. Patient investors who buy quality companies and hold them capture that value. Impatient traders who jump in and out capture only volatility, costs, and taxes. This is the foundation of Buffett's boring method. Value investing principles, economic moats, long-term thinking, compound interest, disciplined inactivity, contrarian thinking during market extremes. None of these concepts are complicated. But combined, applied consistently over decades, they create results that seem almost magical. The Coca-Cola case study, boring in action, To truly understand how Buffett's boring method works in practice, there's no better example than his investment in the Coca-Cola Company. This single investment illustrates every principle we've discussed and demonstrates how patient capital deployment in a boring business can generate spectacular wealth. The year was 1988. The stock market had just experienced Black Monday, the devastating crash of October 1987 when the Dow Jones Industrial Average plummeted over 22% in a single day. Investor confidence was shaky, fear lingered, and Coca-Cola, despite being one of the world's most recognized brands, was still recovering from one of the biggest marketing blunders in corporate history. In 1985, Coca-Cola had made a catastrophic decision. After a century of success with its original secret formula, the company decided to change the recipe, launching New Coke in a misguided attempt to compete with Pepsi's growing market share. The backlash was immediate and fierce. Consumers revolted. They wanted their original Coke back. Within months, the company had to bring back the original formula, branding it Coca-Cola Classic. The damage to the company's reputation was done. The stock price had taken a hit. The market was wary. This is precisely when Warren Buffett started buying. Between 1988 and 1989, Berkshire Hathaway invested approximately $1.3 billion, acquiring about 7% of the company and becoming its largest shareholder. To put this in perspective, this represented roughly 40% of Berkshire's entire equity portfolio at the time. It was a massive, high-conviction bet on a company many investors were avoiding. Why? What did Buffett see that others missed? He saw a company with one of the widest economic moats in existence. Coca-Cola's brand power was extraordinary. In 1988, the company was serving over 200 billion servings of its beverages per year across more than 155 countries. The brand had been built over a century of consistent marketing and quality. It represented more than just a beverage. It represented memories, experiences, cultural moments. That's a moat that cannot be replicated quickly or easily. Buffett also saw the company's financial fundamentals. Coca-Cola was generating returns on equity of 25 to 30% consistently. This means the company was earning 25 to 30 cents for every dollar of shareholder equity invested. Those are extraordinary returns, far above what most businesses achieve. Even better, the company was achieving these returns while paying substantial dividends to shareholders. It was creating value and returning cash simultaneously. The business model itself was beautifully simple. Coca-Cola didn't manufacture or distribute most of its products directly. It produced concentrated syrup and beverage bases, then sold them to independent bottlers who manufactured, packaged, and distributed the final products. This asset-light model required minimal capital investment. The company could grow without constantly needing more factories, more equipment, more infrastructure. It just needed to maintain its brand and improve its formulas. Buffett recognized something else critical. The New Coke debacle, which seemed like such a disaster, had actually proven the strength of the brand. When the company tried to change, consumers rebelled not because they hated New Coke necessarily, but because they loved the original Coke so deeply. The attempted change and subsequent reversal had demonstrated that Coca-Cola was more than a product. It was an emotional connection. And emotional connections create pricing power. There was also a global growth story unfolding that Buffett understood better than most investors. In 1988, 70% of Coca-Cola's profits came from international markets. But in many of the world's most populous countries, per capita consumption was still remarkably low. In China, with over 1 billion people, Coca-Cola consumption was a fraction of what it was in the United States. As these markets developed economically and populations gained purchasing power, the growth potential was enormous. Buffett wasn't buying Coca-Cola for what it was in 1988. He was buying it for what it would become over the next 20, 30, 40 years. Let's talk numbers. At the time of Buffett's initial purchases, Coca-Cola shares were trading at about $43.85 per share. The company was earning about $1.04 billion in net income. That put the price-to-earnings ratio at approximately 16 to 18 times earnings. Not cheap by traditional value investing standards. Some critics argued Buffett was overpaying. But Buffett wasn't looking at static valuation metrics. He was calculating the discounted value of future cash flows, and his analysis suggested the market was grossly underestimating Coca-Cola's long-term potential. The results speak for themselves. In the first 10 years after Buffett's investment, from 1988 to 1998, Coca-Cola stock delivered a return of 14 times the invested capital, equivalent to approximately 30% per year when dividends were reinvested. The $1.3 billion investment had grown to over $13 billion in a decade, but Buffett didn't sell. He held. He continues to hold those shares today. As of 2022, Berkshire Hathaway owns approximately 400 million shares of Coca-Cola, representing about 9.1% of the company. The cost basis remains that original $1.3 billion investment from 3 decades ago. The current value exceeds $25 billion. That's a return of over 1,800% on the stock price alone. But here's the truly remarkable part. Coca-Cola pays dividends. In 2021, Berkshire received $672 million in dividend payments from Coca-Cola. That single year's dividend represented over 50% of the original investment. Every year, Coca-Cola pays Berkshire more than half of what Berkshire originally invested, and they still own all the shares. This is compound interest in its purest form. This is patience rewarded. This is the boring method creating extraordinary wealth. Buffett bought a simple business that makes sugar water. He held it through market crashes, recessions, changing consumer preferences, health trends favoring less sugar, competition, and countless other challenges. He did nothing. He just held. And that decision to do nothing, to be boring, to remain patient, generated returns that most active traders dream of, but never achieve. The Coca-Cola investment also illustrates Buffett's contrarian thinking. He bought when others were fearful after Black Monday. He bought a consumer staples company when technology and growth stocks were capturing headlines. He bought a mature business when conventional wisdom said emerging markets or new industries offered better opportunities. He ignored the noise. He focused on fundamentals. He understood that a strong business with pricing power, global reach, and brand dominance would create value regardless of short-term market sentiment. What makes this case study so instructive is that it's replicable. Not in the sense that you can find another Coca-Cola and buy it at 1988 prices. But the principles Buffett applied can be used by any investor. Find businesses with strong competitive advantages. Understand their economics. Wait for reasonable prices. Buy. Hold for the long term. Ignore short-term volatility. Let compound interest work. Be boring. Be boring. Buffett has other examples that follow the same pattern. American Express, purchased in 1991, remains in the portfolio. Geico, acquired fully in 1996, but first invested in during the 1970s. See's Candies, purchased in 1972 for $25 million, has since generated over $2 billion in pre-tax earnings for Berkshire. None of these are exciting businesses. None of them promise revolutionary growth. But all of them have strong moats, generate consistent cash flows, and reward patient ownership. Compare this to the average investor's experience. Research shows the average holding period for stocks has dropped from roughly 8 to 10 years in the 1950s and 1960s to just a few months today. Investors are constantly trading, chasing performance, reacting to news, trying to time the market. All that activity generates costs and taxes while reducing returns. Buffett's approach inverts this completely. He spends time finding the right businesses, but once found, he stops acting. The activity happens in the research phase. The returns happen in the inactivity phase. There's a deeper lesson here about risk. Many people think of volatility as risk. When stock prices fluctuate, they feel nervous and want to do something. But Buffett views risk differently. To him, risk is the permanent loss of capital. As long as the underlying business remains strong, price fluctuations are meaningless, even beneficial if you're buying more shares. This reframing allows him to hold through market crashes that send others running for the exits. During the 2008 financial crisis, Berkshire Hathaway's stock price fell over 50% from its peak. $500 billion of market value evaporated. Yet Buffett didn't panic. He didn't sell. He knew the businesses Berkshire owned remained fundamentally sound. Geico was still selling insurance. The railroad was still moving freight. The utility companies were still generating power. The crisis was affecting prices, not intrinsic values. So he did nothing. Within a few years, as the economy recovered, Berkshire's stock reached new highs. Those who sold during the crash never recovered. Those who held, like Buffett, captured the full rebound. This mental model, this ability to separate price from value, is perhaps the most critical element of the boring method. It's what allows Buffett to be inactive when everyone else is frantically active. It's what allows him to hold when others are selling. It's what allows boring to beat exciting. Practical lessons for modern investors. So how can ordinary investors apply the boring method? You don't need to be Warren Buffett. You don't need billions of dollars or access to company CEOs or the ability to buy entire businesses. But you can adopt the principles that drive his success. First, change your mindset about time. Most people think about investing in terms of what will happen this month, this quarter, this year. Buffett thinks in decades. When he evaluates a business, he asks if it will still be thriving in 20 years. He asks if its competitive advantages will remain strong. He asks if it will generate more value in 2045 than it does today. If the answer is yes, short-term price movements become irrelevant. This mental shift alone can dramatically improve your investing results. Second, prioritize quality over price. Early in his career, Buffett focused on buying cheap stocks, companies trading below liquidation value. That worked when markets were less efficient, but he evolved. Now he focuses on buying wonderful companies at fair prices. The difference matters. A wonderful company can compound value for decades. A mediocre company bought cheap is still mediocre. It might pop briefly, but it won't create lasting wealth. How do you identify quality? Look for companies with strong brands that command customer loyalty. Look for cost advantages that allow the company to earn higher margins than competitors. Look for network effects where each additional customer makes the product more valuable. Look for high switching costs that make customers reluctant to change providers. These are the characteristics of economic moats. Third, embrace patience as a competitive advantage. In a world obsessed with instant results, your willingness to wait years for an investment thesis to play out is incredibly valuable. Most professional investors can't wait. They're judged quarterly, they're pressured to show results. You don't have those constraints. Use that freedom. When you find a quality business at a reasonable price, buy it and hold it. Don't check the price every day. Don't react to quarterly earnings. Don't sell just because the stock has gone up. Let compounding work. Fourth, understand that inactivity is a strategy, not laziness. Buffett's lethargy bordering on sloth isn't about being passive. It's about being selective. He spends enormous time researching businesses, reading financial statements, understanding industries. But once he's made an investment, he steps back. He trusts his analysis. He gives the business time to prove itself. This is the opposite of active trading, where people spend all their time executing transactions but little time understanding what they own. Fifth, build cash reserves for opportunities. Buffett keeps substantial cash on hand, sometimes criticized for it when markets are rising. But that cash becomes incredibly valuable during market crashes. In 2008, when credit markets froze and banks were desperate for capital, Buffett had billions available to invest on favorable terms. In 2020, during the initial pandemic crash, Berkshire had over $140 billion in cash. This dry powder allows him to be greedy when others are fearful. For individual investors, this means maintaining an emergency fund and not being fully invested at all times. When opportunities arise, you'll have capital available. Sixth, focus on businesses you understand. Buffett calls this staying within your circle of competence. Don't invest in complex derivatives or industries you can't comprehend. Stick to businesses where you understand how they make money, who their customers are, what threats they face, and why their competitive advantages will endure. This doesn't mean you need an MBA. It means investing in companies whose products and services you can explain simply. Seventh, ignore short-term market noise. Media outlets publish thousands of market predictions, economic forecasts, and hot stock tips every day. Almost none of it matters. Buffett barely watches financial television. He doesn't trade based on Fed announcements or jobs reports or GDP numbers. He focuses on business fundamentals. If a company has a strong moat and competent management, it will create value regardless of what happens with interest rates or inflation this quarter. Eighth, minimize costs and taxes. Every transaction costs money. Every time you sell a winner, you owe taxes. These frictions compound negatively, eating into your returns. By holding quality businesses long-term, you defer taxes indefinitely and eliminate transaction costs. Those savings compound positively. Over decades, the difference between constant trading and patient holding is enormous. Ninth, prepare emotionally for volatility. Even if you buy wonderful businesses at fair prices, their stock prices will fluctuate, sometimes dramatically. In any given year, Berkshire Hathaway's stock price might drop 20, 30, or even 50%. But Buffett knows the intrinsic value of the businesses he owns. He knows that price and value are different things. When prices fall but values remain intact, he doesn't panic. He often buys more. This emotional stability is crucial. If you're going to freak out and sell during the next market crash, you shouldn't own stocks at all. 10th, think about buying pieces of businesses, not trading ticker symbols. This mental shift is profound. When you buy a stock, you're not buying a trading vehicle. You're buying partial ownership in a real business with real assets, real employees, real products, and real customers. That business will continue operating regardless of what its stock price does. Would you sell a successful local business you owned just because someone offered you a lower price this week than last week? Of course not. Apply that same logic to your stocks. The boring method isn't glamorous. It won't make for exciting dinner party conversation. You won't have dramatic stories about timing the market perfectly or catching the next big tech stock before it explodes. But you also won't have painful stories about losing half your portfolio in a crash or missing the recovery because you sold at the bottom. You'll have steady, consistent, compounding returns that build wealth over time. Remember, Buffett has achieved his 19.9% annual returns not by being right every time, but by being right over time. He's made mistakes. He's acknowledged them publicly. He bought airlines before the pandemic, then sold them at a loss. He invested in IBM and it underperformed. He avoided tech stocks during the dot-com boom and was criticized for being out of touch. But his overall approach, his commitment to boring businesses with strong moats held for long periods, has overcome those individual errors. The final lesson might be the most important. The boring method works not because it's complex or sophisticated, but because it's simple and sustainable. It works because it aligns with how wealth is actually created in capitalism. Successful businesses compound value by serving customers better than competitors, by innovating within their niches, by generating cash flows that can be reinvested for growth. As a patient owner of those businesses, you capture that compounding value. You don't need to outsmart anyone. You just need to own quality and wait. This is why Buffett's method kills market volatility. Not because the volatility doesn't exist. Stock prices will always fluctuate. But because when you own quality businesses and plan to hold them for decades, short-term price movements become irrelevant. They're noise. They don't affect your strategy. They don't change your behavior. You're boring. You're patient. And over time, that patience generates wealth that active traders can only envy. Warren Buffett is now 94 years old. He recently announced he's stepping down as CEO of Berkshire Hathaway, though he'll remain chairman. But his legacy isn't just the fortune he's built. It's the proof that patient, disciplined, boring investing works. It's the demonstration that you don't need to be the smartest person in the room or have access to insider information or trade constantly to build wealth. You need to find quality businesses, pay fair prices, and wait. In a world that constantly pushes you to do more, trade more, react more, Buffett's boring method offers liberation. It frees you from the anxiety of checking prices constantly. It frees you from the pressure to time markets perfectly. It frees you from the stress of competing with high-frequency traders and algorithmic funds. Instead, you can spend your time living your life while your investments compound quietly in the background. This is the paradox resolved. Boring beats exciting because boring is sustainable. Patience outperforms speed because patience allows compounding. Inactivity generates wealth because activity generates costs. The method seems too simple to work, yet it has worked for 6 decades and counting. Not just for Buffett, but for every patient investor who has embraced these principles. The stock market remains a device for transferring money from the impatient to the patient. It rewards those who can control their emotions, who can think long-term, who can separate price from value. It punishes those who chase excitement, who trade constantly, who let fear and greed drive decisions. The boring method puts you on the right side of that transfer. Not through genius or luck, but through discipline and patience. So the next time you feel the urge to check your portfolio multiple times a day or to sell because the market dropped or to buy because everyone is talking about some hot new stock, remember? Warren Buffett sitting in his office in Omaha. Remember, his favorite holding period is forever. Remember that lethargy bordering on sloth is the cornerstone of his investment style. Remember that the most boring approach has generated the most extraordinary results. Find quality businesses. Pay fair prices. Hold for decades. Ignore the noise. Let compounding work its magic. Be boring. That's the method. That's the paradox. And that's how you kill market volatility, not by fighting it, but by making it irrelevant through patient ownership of wonderful businesses. If you found value in this exploration of Buffett's investing philosophy, make sure to hit that like button and subscribe to Market Memories for more deep dives into the financial strategies that actually work. Because in the end, the best investment strategy isn't the most exciting one. It's the one you can stick with for decades. And boring, as Buffett has proven beyond any doubt, is beautifully sustainable.